$1,000 won't make you Warren Buffett, but it can stop you investing like a caffeinated raccoon. Because most people get their first grand, hunt for a rocket ship, and watch it turn into a smoking toaster. Buffett's real superpower isn't finding secret stocks in a cave. It's patience, low costs, and not touching the oven every 12 seconds. Before we do the boring Buffett path, rule 1. Do not invest rent money, food money, or your emergency stash. Build that wall first. And money you need in the next 3 to 5 years usually should not ride the stock market roller coaster, because the market does not care that your car transmission exploded on Tuesday. Next rule, if your credit card charges 22%, that's not debt. That's a financial raccoon living in your walls. Pay it off first. Paying high-interest debt down is a guaranteed return. You earn money just by removing the vampire. Once the basics are handled, the legend himself once advised putting 90% in a very low-cost S&P 500 index fund and 10% in short-term government bonds. That's the famous 90-10 idea. Not financial magic, just adult behavior wearing sensible shoes. He did not say buy 17 apps, 3 meme stocks, and a coin named after a depressed frog. An S&P 500 fund gives you tiny pieces of roughly 500 big US companies. Instead of betting your future on one stock, you're buying the whole corporate buffet. It gives your brain fewer chances to cosplay as a genius. The S&P 500 has averaged about a 10% annual return since 1957, before inflation. That does not mean 10% every year. Some years it goes up beautifully, and some years it falls down the stairs holding your conference. But if $1,000 compounds at 10% for 30 years, it becomes about $17,400. At 7%, closer to an after-inflation estimate, it's about $7,600. That's compound interest. Your money starts hiring tiny employees who also start hiring employees. Meanwhile, your savings account is doing breathing exercises. To get those returns, start with a broad index fund, like a low-cost S&P 500 ETF or a total market ETF. Some major broad market ETFs charge an expense ratio of around 0.03% per year. On $1,000, a 0.03% fee is about 30 cents a year. 30 cents! That's not even enough to emotionally support a vending machine. But a 1% fee on $1,000 is $10 the first year, and these fees compound over time. $10 sounds tiny until you remember fees multiply like evil yogurt. Don't pay someone a luxury fee to underperform in a nicer suit. Your investment checklist. Choose assets that are diversified, low-fee, liquid, and understandable. If you can't explain it without using smoke, mirrors, and a Discord invite, skip it. With $1,000, you do not need 20 positions. You need a clean start, not a garage sale of ticker symbols. Many brokers allow fractional shares, meaning you can invest specific dollar amounts instead of waiting to buy one majestic, expensive share. A simple $1,000 allocation example is $900 in a broad stock fund and $100 in short-term treasury bills, a money market fund, or a cash-like buffer. That cushion will not make you rich, but it will stop you crying into your brokerage app when things get spicy. Because risk tolerance means how much red you can see before your soul exits your body. The biggest danger isn't picking the wrong fund. It's selling during the first scary drop because your feelings went feral. A 30% market drop reduces a $1,000 investment to $700. That feels illegal. It is not illegal. It is Tuesday in the stock market. To survive the drops, use dollar cost averaging, the practice of investing equal amounts of money at regular intervals. Investing $100 a month for 30 years at an 8% return yields approximately $149,000. The $1,000 starts the machine, but the monthly habit makes future you less financially crispy. Automate your investments to maintain consistency, because human motivation is basically a drunk intern.
And utilize tax-advantaged accounts when available, like a 401k, IRA, ISA, or PEA. Take advantage of employer matches on retirement contributions because it is literally free money. Ignoring a match is like refusing a coupon and then crying in the cereal aisle. Don't tip the tax monster for fun. What about individual stocks? Sure, Buffett buys businesses, but he also reads annual reports like bedtime stories. For beginners, limit individual stocks or play money to 5% or 10% of your total portfolio. 5% of a $1,000 investment is $50. $50 is enough to learn. It is not enough to ruin Thanksgiving. Not the rent, bro. Next, rebalancing restores your portfolio to its target mix, such as trimming stocks back to 90% if they grow to 95%. Rebalancing is boring. That's the point. Your money doesn't need a DJ. A recommended investment schedule is monthly contributions, quarterly check-ins, and yearly rebalancing. Do not check the account every hour. You're not farming tomatoes. Remember, investing means owning actual assets, whereas gambling relies on hype. If the plan requires a stranger to buy your bag later, congratulations, you're holding a bag. The core simple plan is clear dangerous debt, keep emergency cash, buy low-cost diversified funds, automate, and wait. That's the ancient wisdom. Extremely disappointing for anyone wearing driving gloves indoors. $1,000 is not the finish line. It's the moment your broke era starts getting nervous.